Okay, so now let's try to understand a practical example for permanent differences where the tax rate is 21%. This is a case of Amazon Incorporation whose pre-tax financial income as per GAAP is $200,000 and the GAAP pre-tax income which is above income is income after adjusting for the following, which means company has earned municipal bond interest which is tax exempt for federal tax. There is no tax, and the amount for that is, let me correct this number, this is not this much high. Let me just correct this number. So this number is $50,000. So what they are saying, that company has earned a interest of 50,000. Now this interest is tax free as per the federal tax, but in the books of the company this is showing as an interest. Similarly, the life insurance premium for which company is beneficiary and which is non-deductible for tax. Now life insurance premium which the company has paid is worth 10,000, but this should not be deducted in the books of the company. Now they are saying we need to calculate and record the income tax expenses assuming 21% as the tax rate. So what we will say that, okay, our books revenue, or what we call as GAAP revenue, is how much at the time? You can say that is $200,000. And if I always need to write books here and tax here, okay. Now let's treat one item which is like municipal bond interest, which is 50,000. So what you will say, in your books of accounts municipal bond is 50,000 plus showing because that is an income, right? But in tax it should not be shown as an income, because on income tax laws, federal tax laws, there is no taxes on it. So you need to write something here on the basis of which these two numbers will match. So you will say, if I write it here minus 50,000, then what will happen? This number will become 0 and both of them will match. So there is an adjustment of 50,000 here. So what you will do, you will reduce that 50,000 from your book revenue. So I write it as interest adjustment of 50,000. Then next item, let me just remove this from here again. And next item here is our life insurance premium, for which 10,000 expense has been treated in the company's books. So you will say, in the books of the company we have shown 10,000 as an expense, but in the income tax or federal tax there should not be any expense, because federal tax says that there will be zero deduction of those expenses. These expenses won't go into P&L. So what you will write here so that both of these number will match, you will say I will write here as 10,000 as favorable or plus. So this will become 0 based upon these both numbers, and finally the numbers will match. So you will say the adjustment which I have done here for premium is how much? You will say it is plus 10,000. So if you have done this, you will say effectively my income for taxation purpose will be $160,000. So on that $160,000, enacted tax rate is 21%. So you will say on that we will allow a 21% tax rate. So you will get the tax amount. Okay. So the same thing has been shown here as an income tax solution, wherein your GAAP income is here, and finally we have reached to tax income, which is 160,000 as I have shown you above. And then on this 160,000 there will be tax applications, which is 160,000 multiplied by 21%, that gives us a number of 33,600. So this is our income tax payable. We will be paying this tax to the government, and this is our current tax, right? So what will happen? You will see that because of this there is a permanent difference. Why permanent difference? Because today they have given us the relief from paying taxes on I can say interest on basically bonds or FD. So there is no tax. Tomorrow also it won't be taxed, and in the next year, next to next year, it won't be taxed. So if it won't get taxed, so there is a permanent difference. So when there is a permanent difference, you know no deferred tax assets and liabilities are arised. Only in case of temporary difference, deferred tax assets and liabilities gets arise. Now we need to see the journal entry. So for journal entry, you know that you will need to pay 33,600 as a tax to the federal tax department. So you will be crediting that income tax payable. Why crediting? Because this is your liability and your liability is increasing to pay that. And you will be debiting your income tax expenses. Why? Because you debit all the expenses and losses and credit all the incomes and gains. So this is your expense which is shown here. So this has been debited and your income tax payable has been credited by 33,600 as well, and this will be your accounting entry.